In the summer of 2002, America was still reeling from the Enron collapse when another corporate giant came crashing down with even more devastating force. WorldCom, once the second-largest long-distance telephone company in the United States, had been cooking its books to the tune of $11 billion, making it the largest accounting fraud in American history at that time. What started as a small long-distance reseller in Hattiesburg, Mississippi, had grown into a telecommunications empire worth $65 billion at its peak, employing over 60,000 people across the globe. But beneath the glossy annual reports and soaring stock prices lay a web of deception so intricate and brazen that it would ultimately destroy not just the company, but the retirement savings of countless employees and investors who believed in the American dream of corporate success. The mastermind behind this colossal fraud was Bernie Ebbers, a former milkman and nightclub bouncer who had transformed himself into one of the most powerful CEOs in corporate America. Ebbers built WorldCom through an aggressive acquisition strategy, purchasing over 60 companies in the 1990s, including the crown jewel acquisition of MCI Communications in 1998 for $37 billion. This deal created MCI WorldCom, making it the largest corporate merger in history at that time. Ebbers cultivated an image as a folksy, down-to-earth executive who wore jeans and cowboy boots to board meetings. But behind this facade was a ruthless businessman, obsessed with meeting Wall Street's quarterly earnings expectations. He owned a 15,000-acre cattle ranch, a yacht-building company, a minor league hockey team, and had borrowed over $400 million from WorldCom to fund his lavish lifestyle and business ventures, using his WorldCom stock as collateral. The fraud began in earnest in 1999, when the telecommunications industry started experiencing a severe downturn following the dot-com bubble burst. As competition intensified and pricing pressures mounted, WorldCom's revenues began declining, but Ebbers refused to acknowledge this reality to Wall Street analysts. Instead, he pressured his finance team, led by Chief Financial Officer Scott Sullivan, to find ways to make the numbers work. Sullivan, a former accountant who had joined WorldCom in 1992 and quickly risen through the ranks, became the architect of an elaborate accounting scheme that would eventually dwarf even Enron's creative bookkeeping. The fraud involved two primary methods. First, WorldCom improperly reduced operating expenses by releasing accrued reserves that had been set aside for future liabilities, and second, they reclassified ordinary operating expenses as capital expenditures, which could be depreciated over time rather than expensed immediately. The genius and audacity of WorldCom's accounting manipulation lay in its simplicity and scale. Line costs, which represented payments to other telecommunications companies for completing calls on their networks, were WorldCom's largest operating expense, typically accounting for about 50% of revenues. These costs should have been recorded as operating expenses in the period they were incurred, but Sullivan's team began capitalizing billions of dollars of these routine costs, spreading them across multiple years instead of recognizing them immediately. This accounting sleight of hand had an enormous impact on WorldCom's reported profitability because it simultaneously reduced operating expenses and increased capital expenditures, making the company appear far more efficient and profitable than it actually was. Between 1999 and 2002, WorldCom improperly capitalized approximately $7 billion in line costs alone, while also manipulating reserve accounts by another $4 billion. The fraud was orchestrated by a surprisingly small group of executives and accountants within WorldCom's finance department. Scott Sullivan recruited David Myers, the company's controller, and Buford Yates, the director of general accounting, to execute the fraudulent entries. Betty Vinson, a senior manager in the accounting department, and Troy Normand, another accounting manager, were tasked with making the actual journal entries that moved billions of dollars from operating expenses to capital accounts. These mid-level employees initially resisted the instructions, knowing they violated basic accounting principles, but were told by their superiors that the adjustments were temporary and would be corrected in future quarters when business improved. Vinson later testified that she was assured these were one-time adjustments, but as the telecommunications downturn persisted, The fraudulent entries became larger and more frequent, ultimately consuming her career and landing her in federal prison. The house of cards began to crumble in March 2002, when the Securities and Exchange Commission launched an investigation into WorldCom's accounting practices, prompted by anonymous tips from company insiders who had grown increasingly uncomfortable with the fraudulent activities. As the SEC investigation intensified, WorldCom's internal audit department, led by Vice President Cynthia Cooper, began conducting their own review of the company's capital expenditure accounts. Working nights and weekends to avoid detection by Sullivan's finance team, Cooper and her small team of internal auditors discovered the massive reclassification of line costs that had been hidden in the company's books. When Cooper brought her findings to the audit committee of WorldCom's board of directors in June 2002, the magnitude of the fraud became undeniable. Within days, Sullivan was fired, and on June 25, 2002, WorldCom announced that it had improperly accounted for $3.8 billion in expenses, though this figure would eventually grow to over $11 billion as the full scope of the fraud was revealed. The announcement triggered an immediate catastrophe for WorldCom and its stakeholders. The company's stock, which had traded as high as $64 per share during the height of the telecommunications boom, became virtually worthless overnight. On July 21, 2002, WorldCom filed for Chapter 11 bankruptcy protection, making it the largest corporate bankruptcy in United States history at that time, surpassing even Enron. The bankruptcy wiped out approximately $180 billion in market value and destroyed the retirement savings of thousands of employees who had invested their 401k accounts in WorldCom stock. More than 20,000 employees lost their jobs as the company struggled to restructure and eventually emerged from bankruptcy as MCI Inc., a shadow of its former self. The ripple effects extended throughout the telecommunications industry and contributed to a broader crisis of confidence in corporate America that had begun with Enron's collapse just months earlier. The criminal prosecutions that followed were swift and severe, reflecting the government's determination to hold corporate executives accountable for their crimes. In March 2005, Bernie Ebbers was convicted on 9 counts of conspiracy, securities fraud, and filing false reports with regulators, and was sentenced to 25 years in federal prison, making him 78 years old before he would be eligible for release. The judge who sentenced Ebbers noted that while he may not have known the technical details of the accounting fraud, he was clearly the driving force behind the culture of meeting earnings targets at any cost. Scott Sullivan, who cooperated with prosecutors and testified against Ebbers, received a 5-year prison sentence. David Myers was sentenced to 1 year and 1 day, while Buford Yates received 1 year and 1 day as well. Even the mid-level employees who made the fraudulent journal entries faced criminal penalties. Betty Vinson received 5 months in prison and 5 months of home detention, while Troy Normand was sentenced to 3 years of probation. The WorldCom scandal had far-reaching consequences that reshaped corporate governance and accounting oversight in the United States. The fraud contributed to the passage of the Sarbanes-Oxley Act of 2002, which imposed strict new requirements on corporate executives and auditors, including personal certification of financial statements by CEOs and CFOs, enhanced penalties for securities fraud, and stronger protections for whistleblowers. The law also created the Public Company Accounting Oversight Board to regulate the auditing profession more strictly. WorldCom's external auditor, Arthur Andersen, which had also been Enron's auditor, was already facing criminal charges for obstruction of justice and ultimately ceased operations in 2002, eliminating one of the Big Five accounting firms. The scandal also highlighted the importance of internal audit functions, and Cynthia Cooper became a symbol of corporate courage, sharing Time magazine's Person of the Year award in 2002, along with other corporate whistleblowers. The WorldCom case remains a stark reminder of how quickly corporate success can transform into criminal enterprise when executives lose sight of their ethical obligations to shareholders, employees, and the broader public. The fraud succeeded for as long as it did because it exploited the complex nature of telecommunications accounting and relied on the trust that investors place in corporate financial statements. Bernie Ebbers, who once controlled a company with annual revenues of $39 billion, died in prison in 2020, serving as a cautionary tale about the ultimate price of corporate greed. The $11 billion accounting fraud that destroyed WorldCom demonstrated that no company, regardless of its size or apparent success, is immune from the devastating consequences of financial manipulation. For the thousands of employees who lost their jobs and life savings, and for the investors who trusted in the integrity of corporate America, WorldCom's collapse represented not just the failure of one company, but a betrayal of the fundamental principles that underpin our entire economic system.